Hey, good morning to you, everyone. It is time for Trader Talks in today's market. I am not Kevin Horner, who's out today, and he's going to be out tomorrow. He's actually at a workshop right now, but I'm happy to be sitting in for you. My name is Brent Moores, and I'm joined by Barb Armstrong, who's helping me out in the chat. Always appreciate Barb. So as you have questions, feel free to type those in the chat. I'll try and do my best, and Barb will help you out as well. And what are we going to do today? Well, we're going to look at the markets. Well, I'll get to that in just one sec, but let me just mention this first. You can always follow us on X, formerly known as Twitter, for additional information. Barb and I both post most days of the week. And at Brentmore CS, at Barb Armstrong CS are our X handles there. And just remember the information I go through today is for informational purposes only. It's not a recommendation of any security strategy or chart type. And we will be looking at individual stocks, maybe even look at some potential trades. They're just examples for example purposes only, and they're not any recommendation for you. And options do carry a high level of risk and are not suitable for all investors. The paper money software application is provided for educational purposes only. And Schwab does not recommend the use of technical analysis as a sole means of investment research. Past performance is no guarantee of future results. And let's see, that's there we go. We live in volatile times, folks. I don't need to tell you that investment returns will fluctuate and are subject to market volatility because we've seen a lot of that this week. I'll tell you that. So let's go through the agenda right here. But before I do so, let me just mention this. I'm glad you're joining me. Whether you're watching live or on a recording, we're just glad you're here. I see some familiar names there. And let's just a welcome to everybody. First, we're going to go through the general market. We'll look at general indexes and market indexes and see what's going on today. I know futures were down. We'll see. We just had the opening bell. We're going to break that down into various sectors as well and look at some of the strength there. We're going to look at different time frames, support and resistance levels, trends, and potential target levels, stop levels as well. So that's the task in front of us, everybody. Here, I was actually pulling that up just a little bit, but let's start with the S&P 500 index, where I think we normally do. And I'm going to start off with the 20 and 50-day moving average on here. And you can see, well, we're already down almost 1.5%. In fact, these lows, I mean, I think I was hoping at least that our January low here would have held, but because what happens is we had that low, and even though intraday earlier this week we tested below that, each time we closed there or above. Well, we'll see where the rest of the day goes. Now, we've seen a lot of volatility this week. In fact, if we look at this, you can see some of the swings we've had when the market will open way down. I'm thinking of this was Tuesday. Market swung way down on open because this was the previous close. And then it climbed its way back up all day long. And then by the end of the day, we had swung way back down. So we're seeing a big intraday swings right now on the market. So we'll just have to wait and see where we end up the day. But that would be probably a pretty significant break in the market there. And if I were to look further at another potential support level, that may be it. The next one down here, I don't know. There's the general trend of late has been pretty bleak right here over the last few weeks. Now, that's the S&P 500, which is a market cap weighted index. You guys have probably all heard that. Just a few stocks can certainly impact the overall market. We hear of the Mag 7. Some of those really large mega cap stocks can certainly affect that. Let's check out some market breadth here, though. So what I'm going to do is I'm going to do the SPX equal weight, And before I click my enter key on this, I just want you to get a visual of what the chart is looking like right now. And then when we click on the equal weight, it's maybe on the equal weight, we have not broken down below those lows here, okay? So when I look at potential support level, still not looking good, still looking relatively similar here on a lot of things, but we still have some lows here to contend with, a potential support level to contend with on the equal weight. So that's just giving us a broader view of the market. These are still large cap stocks here. It's probably not surprising, though, that the SPX has broken to lower, some lower levels, because when you think about like the Nasdaq, here's the NDX. Look how far below the Nasdaq 100, which the Nasdaq 100 strips out financials. It's tech heavy. It tends to move more, tends to be more volatile, and that is a great thing when the market is going up, because it continues to go, because it tends to outperform, and it's not such a good thing when the market goes down. And in fact, let me just do a quick aside on that and the importance of, there's a concept that I know some of you have heard of called beta in the market. Beta. Beta is just a measure of how much a stock or index moves in relationship to the S&P 500. And what you can see, and the benchmark would be 1. Basically, if a stock has a beta of 1, it moves approximately the same amount of volatility, essentially, as stocks in the S&P 500. Nasdaq stocks tend to be greater than 1. So Nasdaq tend to be greater than 1. Most of the stocks in the Nasdaq are that way. And so that's great, because if the market is going up and you have a beta that's greater than 1, you tend to have outsized performance. But if you have a beta that's less than 1, then you tend to have undersized performance if the market is going up. But it's not, don't confuse that with the stock is a great stock. Just consider that to be just what the beta of that stock is. So sometimes you may hear this in life, in your trading life, you may hear investors, or maybe your friends, or maybe even investment professionals bragging about their market returns. Well, here's my question for you. Are the returns they're bragging about over periods of overall strong market performance? Because if it is, what the case may be is they may just be invested in a lot of high beta stocks that tend to outperform when the market is doing well. And it's not through investment skill, it's through high beta stocks. The challenge becomes when the market drops, because those high beta stocks tend to drop even more. And therefore, when you're looking at investment performance and you're trying to rate someone who's invested stocks, try and look at both good periods and poor periods of performance, and that is probably a truer measure. Those NASDAQ stocks tend to be higher beta stocks there, and so probably not surprising we're getting a bigger drop there in the market on the NASDAQ. Here was our January low, and you can see we've already breached that right there. Okay, so there we go. That's the NASDAQ. Let's move on to small caps. All right. So because the the Nasdaq and the S&P 500 are large caps. Here we see even a bigger breach on small caps. And here's kind of our January lows. Clearly, these guys have been getting hit even harder. And we mentioned, Kevin and I was on with Kevin yesterday on this show on Trader Talks, and we talked about this, but I think it bears repeating. The Russell 2000 small caps, for a while, one reason they were underperforming was interest rates were just sticking high, and that tends to hurt them. Well, interest rates have actually come down. We'll look at that in just a minute here. But interest rates have come down, and yet small caps are struggling. Okay, what's up with that? Well, there's two main things that that are really going to affect small caps. One is, we mentioned interest rates. Another is just economic softness, and there's a concern with more economic softness coming down the pipe here. And small caps, which are smaller companies, tend to be less financially stable, tend to get hit even harder. Now I can go to a longer time frame here and look for past support levels, possibly back in September. But let's do this. Let's go back to, say, a 3-year chart here. And any significant areas? Certainly this was kind of a high level here on small caps. And that is probably a relatively significant support level, I would say right now, on this. So if we get there, we'll have to wait and see if we bounce on that. And I kind of neglected to look at that longer term chart on the Nasdaq. Here's a 3-year on the Nasdaq, and that was really a strong performance after a really tough 2022. Longer term support, I don't know. I mean, I would say this is probably a reasonable support level here on this. But if using moving averages, let me go to a 3-year daily chart, actually. There's a daily chart on the 3-year. And what you can see is our moving averages are lower, are both heading down on that. Same thing with the Russell 2000. These are a 20 and a 50-day moving average. And when we're below them, and they're both sloping down, that's a bearish sign as well. Okay. Trade and Grow in the chat said Russell hasn't gone anywhere for 5 years. The Russell has underperformed for a long time. I don't know how long I've been talking about the Russell just being the underperformer. There's been a few exceptions during that period, but overall, it has certainly underperformed for a long period of time here. So let's move on and break this down just a little bit further here. Then I want to get to interest rate. In fact, while we're on interest rates, let's talk about interest rates. Okay, so here's the TNX, here's the 10-year. And you can see we've had a nice little drop in the 10-year. I mean, we went from 4.8%. This is a 10-year interest rate. Just move the decimal point over one spot, 4.8% down to we're about 4.3. So a little bounce right now. And that's, this interest rate is going to move opposite what bonds are doing. And so here's what bonds have been doing. And this is the bond price. Remember, bond price and bond yields are opposite one another. Well, why are bond yields going down? Well, people are buying more bonds. This is showing bond demand right now. When people buy more of an asset, the price, there's higher demand and prices tend to go up. The price of the bond has been going up for the most part. Dropped for the last couple of days maybe, but it's been going up for the most part. So the price of that bond has been going up. Well, what happens to yields when the prices of bonds, when there's more demand, there's more buying of bonds, this is what happens for yields. Now, this drop has not substantially affected the has not as substantially affected the Fed Watch tool here. This is the Fed Watch tool, okay? And this is for the next meeting, which is in what, a couple weeks, March 19th. And just for those of you who aren't familiar with this, this is how you read this. You look at the current rate, 425 to 450. So when we look up at this and we're saying, well, what's it going to be? What's the Fed going to target for interest rates in the future? This is the Fed funds rates. This is the short end of the curve. I was just looking at the longer end of the curve, the 10-year. There's not necessarily a direct correlation. In fact, last time they did substantial cuts in the short-term rate, the long-term rate actually went up after that. But this gives you an idea of what they're looking at. So basically about a 7% chance that we see that drop in this month in the meeting. So we're going to say that probably not very likely here. And what you can see also is you can see this hasn't really changed that much over the past couple weeks here. In fact, the odds of more stability have kind of gone up, I guess, of less likelihood of change here over the past month. And that's probably not surprising. As you get closer to a meeting, as you get closer to a Fed meeting, the odds either are going to go either to 100% or 0% or closer to that typically. Sometimes we go into a meeting with just like, we have no idea whether they're going to cut and it's really close to 50-50. But usually as you get closer to the meeting, between what the Fed tells you, in the press reports and whatnot, in their press conferences, you get a little bit of better idea. But let's go out in time here on this. Let's go out to May. Okay. Notice odds of a rate cut starting in May go up significantly here. And if we go to, we'll say the end of the year, the December meeting, remember, our current target rate is 425. So basically, according to this, and this is just an estimation, there's no guarantee on this, only about a 10% chance that we're where we're at or possibly a little higher on that Fed funds rate by the end of the year. I said that wrong. This is 1%, 1.5%, according to this, and this changes by the end of the year. 1 rate cut. This is 2 rate cuts. This would be considered 3 rate cuts. So we're still pricing in some substantial rate cuts towards the end of the year here on this on that Fed Watch tool. Now, let's why all these changes? Well, you can see a lot of volatility in the market. Let's go to the VIX here. Someone who was it? Carol mentioned. Let's look at that VIX. This is a 6-month chart of the VIX. And one thing with the VIX is you'll often hear it said the VIX is mean reverting. In other words, you kind of have these kind of more of an average level. We'll call that kind of an average level. But every time it spikes up, or it may dip down. But it tends to come back to more of an average level. We're going to call that average level for the last 6 months at least has been around 15, 16, 17 range, somewhere in there. And what we have is you see it spiked out. I've kind of highlighted the spiked parts on the chart here. You see, how long has it lasted on each of these? Well, a few days, right? Few days. A day. We've actually stayed up several days in this level here. In fact, today, we're increasing that. So the VIX doesn't measure, the VIX is forward-looking. This is true for implied volatilities. The VIX is just a measure of implied volatilities or option prices. Options tend to be more expensive when people expect more volatility in the market. Well, so it's not looking at past volatility, and we've had a whole bunch. It's saying we're expecting more volatility going forward. Now, that can be advantageous at times. Some options traders will say, hey, I want more volatility in the markets. Some stock traders will say that too, but it does mean it's a little bit more of a roller coaster ride there on that. So that's your VIX right now here on this. And yeah, the George in the chat said the VIX is the annualized theoretical and implied volatility of 30-day days to expiration options, but it's annualized there. So basically what this is saying is, according to what this is expecting in terms of movement, it's expecting about it'd be like a 24% plus or minus 24% move in S&P 500, given the next 30 days of options annualized there. Okay, so there we go. That's that. So a lot of uncertainty still ahead, and we're going to look at some sectors that are maybe handling it a little better in just a minute. But let me just go through some questions real quick, and then I want to get to some other asset classes and move beyond these major ones and get to some individual sectors. Mircea says, is there a thinkorswim script that can get me an estimated price based on a discounted cash flow model? No, not to my knowledge. There may be something out there that I'm not aware of there on that. So good question. Bollinger Bands. I did not pull up Bollinger Bands, but you certainly can look at Bollinger Bands. Let me do this real quick. Let me go to the SPX just real quick here. And let's just because I've talked about volatility. There are other volatility indicators you can use out there. And one of those is Bollinger Bands. And with the wider, basically what the Bollinger Bands do is the default is a 2 standard deviation move here. So do you see that? You see the red line and the purple line? This is basically giving you a channel based on 2 standard deviations move in the market. And the tighter the Bollinger Bands, the less movement we've seen. Well, what have we seen? We've seen the Bollinger Bands widen. That's just another indication of the more extreme volatilities we've seen in the markets here. Now, there are some parts of the market that have been doing quite well. Here's gold. Hold on, and we're using these futures on this. We're not trading futures today, but this is a way of looking at commodities. Look at how strong gold has been. Well, gold tends to thrive, is often known as kind of this flight to safety type asset. And so there's a lot of uncertainty, whether you're a pro-tariff person or an anti-tariff person. They create more uncertainty right now in the markets, what's been going on. And so the more uncertainty tends to, it's not always a perfect correlation, but it tends to buoy gold. And that's exactly what you've seen. There's also been more buying with gold. It's not just U.S. investors buying gold. Central banks are buying gold. Other countries are buying gold. Some countries, like there's BRICS countries out there that are they're trying to shy away from the dollar more and buying fewer dollars. They're not as comfortable with that, and so they tend to be buying more gold. So we've seen that price of gold go up. I mean, let's do this. Let's go to a 3-year chart here. Let's look at the last 3 years on gold and just see how much we've gone up. Now, this is not, I don't know, this is not an indication of what it's going to do the next 3 years, but that's 83% over the last 3 years, what gold has done. That's great. That's really strong. But that's that's different than the historical averages, by the way. If you go back, say, 100 years or something, or 50 years, gold has significantly underperformed in the long term, say, just equities, large cap stocks. I don't know what the future holds, but that's what it's been doing lately. And so, sometimes people have held gold just as kind of a way to diversify their assets in their portfolio. And not so much seeking higher returns. Well, I don't know if things are changing here on that, but certainly we have much more buying of gold lately. Here's another asset that's been moving, but it kind of going the other direction, and that is oil. Here's oil. You can see the trail off in oil, and just remember with oil prices. I mean, I guess with anything, but when I think of oil, this is crude oil. You can do like Brent crude as well, Brent oil as well. That'd be BZ/BZ. It's going to look pretty similar. There's the supply side and there's the demand side of the equation. Okay. So more drilling, more refining capacity, less regulation can certainly affect the supply side of things. Demand side, a lot of it is expected economic demand, put it that way. And so both can certainly affect that. But when you start hearing talk of, well, the economy may be slowing down, that certainly can affect the demand side. And remember, this is opposite what I was talking about bonds before, where the demand was going up for bonds. And so bond prices were going up, rates going down, yields going down. This is the opposite. Demand going down, less potential perceived demand is going to do that. Now, where is this going to end? Look at this. If we go to, say, a 3-year chart, let's go to a 3-year. Let me get on my little drawing tool here. Let me just do 3 years here. Here's 3 years. Where's our low? This is our low. This represents our low, okay, for the last 3 years on oil. Oil hasn't, we haven't seen that much in terms of spiking on oil here, but we're about almost as low as we've been over the past 3 years on that. So I don't know, where we go from here, but I think a lot of traders would consider that as a pretty significant support level to see if we can hit that on there. All right. So that's oil. I think those are the major indexes I want to hit, but I do want to hit some notable stocks in the market here, and I also want to look at some sectors. And before I run out of time, we better get a start on that. Earnings this morning. There we go. Burlington had earnings come out this morning. Let me go to a shorter term chart here. Okay. I haven't read the news on it, but I do know that the market likes that reaction. Up almost 10% right now. Now we're selling off through the day. Very often you see that when you get a big move, it kind of overshoots the mark and then it comes down. If you are looking for a trader, what if they're looking to get in after something like this? Generally, what traders often like to do is they like to look at the market. Now we're only a half hour into the market, so we'll have to see how the day goes. But what we'd like to see is traders like to see a support level established, and then tomorrow a bounce, and it doesn't breach below that. And if we get a bounce tomorrow, either as say a harami or a bullish engulfing or something like that, that is a trigger for some traders to say, look, we had the big move, but it's likely that support is likely to hold. That's how some traders will view that. Other companies that came out with earnings this morning, JD.com came out this morning, I believe. Yeah, they came out this morning. And you can see actual beat the estimate. That's just the bottom line. Of course, a lot of it comes down to guidance or whatever. They're up about, well, roughly 3% this morning. Other stocks that came out with earnings this morning include Kroger. Kroger didn't really gap up as much, but it has certainly moved up a lot, up 4.5% right now on Kroger. So that's a nice early morning mover. And Macy's, yeah, not down 2.5%. So a lot of times there's concern. There's some more tariff concerns on some of these companies right now. In fact, if you look at tariffs can certainly affect demand, but it can also create a substitution effect on that. In other words, there's some products that you're going to buy no matter how expensive they are, for example, right? More defensive type products is what we call them. Well, you think of some companies, yeah, their products, let's take Walmart here, for example. Their products may, it may be more expensive to them to buy some of their products so a lot of them are coming from China, for example. But people still have to buy something. And sometimes they'll shift their preferences from something that's a more expensive store, like maybe Target or something like that, and which has been underperforming, versus a Walmart, which is known to have more of a less expensive products, which relative to Target has been outperforming on that. So that's kind of an area where some people will look to in terms of potential areas of strength in an otherwise struggling market. Now, after market, I'm not going to go through all these because I want to get to sectors. After market today, we have Broadcom, AVGO release earnings. We have Costco, that's probably the biggie today, releasing earnings. We have Gap release earnings, GAP. We have Hewlett Packard, HPE, releasing earnings. So Costco is probably the biggie coming after the market today. If you want to look at sectors, though, and see how sectors are doing, I'm going to go to public watch list. I'm going to go to S&P 500 sector indices. Let me just open that up here. And if you're going to use this watch list, I would suggest that you have a description column on there, because the symbol isn't probably going to make any sense to you. But here's what I'm going to do. I'm going to look at these sectors and just see how strong they are. And one way I'm going to do that is, let me just do a plain chart here. So this is a 9-month chart, no studies on it, but I actually am going to add a study to it. I'm going to add relative strength. This is how strong this is compared to the S&P 500. Okay, some will be stronger, some will be less strong than that S&P 500. And basically, the way you look at it, the way you interpret this is, if it's sloping down, so we'd say, look, here's the relative strength on this, generally kind of going down, that is underperforming the S&P 500. That's underperforming. If it's going up, well, like right here, I'll do a little dash right there. For a short little while, it actually outperformed the S&P 500, outperformed. So this is kind of a neat little way of looking both longer term and shorter term how it's doing compared to that S&P 500. All right. So let's look at some sectors and see. So this is energy, probably a little more weakness in energy. Materials certainly was weaker, maybe, excuse me, maybe turning the corner just a little bit here. Some more strength since, well, in 2025, I can't believe it's 2025, everyone. 2025, we've seen some more strength. It's starting to outperform. By the way, this red line represents where this graph starts. So 9 months ago on this graph, you can use whatever time frame you want. This will represent the starting point, and you can say from start to finish, if we're below that line, that's where, you know, we've underperformed. If we're below that line, we've outperformed. If we're above that line. Don't worry about the y-axis. Don't worry about those numbers here. Look at the slope of the line there. Let's look at industrials. So. For the last 9 months, it's been about the same. And for the last, well, this year, it hasn't moved much either. It's been kind of roughly doing what the market's doing as a whole, industrials. Here's consumer discretionary. What's consumer discretionary doing? It's been weakening lately. Now, I'm focusing right now on the overall for the last 9 months, it's been fairly strong, but lately it's been weakening. Contrast discretionary, and this is what I was trying to get on when I was talking about kind of substitution of if you see higher prices, if you see more economic weakening, you see a substitution, but people still need to buy staples. This graph right here is what staples are doing. And you can see the strengthening in staples right now relative to the S&P 500. Now, staples are candles red right now. We're down today. Everything's down today. But if you're trying to look for relative performance, the relative strength graph may be a way to kind of help you gauge that. And then you can help to identify those sectors that are stronger. Now, consumer staples is not the only sector that's stronger. You can look at healthcare has shown some strength lately. Financials has shown some strength. IT, probably not surprising, has been going down a little bit. By the way, IT tends to be higher beta stocks. To tie us back to the beginning of the discussion, to today's discussion, consumer staples tend to be, and this is kind of a large blanket statement I'm saying, consumer staples tend to be lower beta stocks. Utilities, maybe a little bit of strengthening there on that. Real estate, maybe some strengthening. Is that partially because of interest rates dropping? I would expect that's probably got something to do with it. Okay. So then where are we going to go from here? I'm going to pick on consumer staples today. I'm going to pick on consumer staples today because of its strength and talk about finding individual companies in consumer staples. But before I do that, let me just mention something that I neglected to say earlier. There's a survey link in the chat. Maybe Barb, you could repost that. Barb already posted it 2 or 3 times, and I didn't mention anything because I was in the middle of a thought and I didn't want to destroy my train of thinking there, but there is one. I skipped communications. There's communications. Sorry, I didn't mean to skip communications there. Communications has been strengthening there a little bit there. Okay, outperforming a little bit on that. So this is easy enough for you guys to add yourself. Just add relative strength. It's just one of the studies there. Now, what I'm going to do is I'm going to go back to a normal graph. And what I've done and what you can do if you like is you can go over here and you can create your own watch list for these groups. Now, you don't need to create a watch list. I can go to by industry and go to consumer staples and just show all consumer staples. But there's a problem if I do that. The problem is I get a bazillion little penny stocks and whatnot here. And I don't want to have to scroll through all these. So here's my suggestion for you, I guess. And that is this. Go to the scan. Okay, let me get rid of this left-hand column here. Okay, and we're going to start from scratch here. Go to scan. And you can create a watch list. on those scans. So I'm going to go select, instead of all stocks, I'm going to go to S&P 500. So I'm going to go to public S&P 500 stocks. Okay? And then I'm going to go to intersect with public, and I'm going to go to by industry, and I'm going to go to consumer staples. I'm going to select consumer staples. Run that scan. Now, what is this giving me? It's taking that list of a ton of all these stocks and consumer staples that include all those penny stocks that that you don't, that you may, maybe you have some interest in, maybe you don't, but for our purposes today, for this class, I don't want to look at those. I want to look at consumer staple stocks that are in the S&P 500. And then what you do is, and so there's 38 of them, then what you do is you save it. You go to this little 3-line menu, there's 3 of them, so you go to the middle one, I think, and you save the scan query. You click on Save Scan Query, it's going to bring up a window. You title it, whatever you want to title it, Consumer Staples, S&P 500, and then you save it, okay? I'm not going to do it because I've already done that. Do that for each 11 sectors. I know it's going to take you, it goes really quick because all you have to do after you do one, you can leave all this set up, change it from consumer staples to information technology. Repeat the process 11 times. And you're going, well, that's going to take me 10 minutes. It's going to be worth it because then when you go over here to your personal scan, personal watch list, what will be saved is these S&P 5, I named them S&P 500 consumer staples. And then what I can do is I can go here and I can go through and look at some of these. And I can go, oh, look, Colgate. It's showing some strength lately. We have higher highs, higher lows. Maybe a little bit of bounce, little hold above our moving averages. Is that a potential trade? Maybe. You can go to others. You can scroll down the list. Now, they're not all going to look good. Okay, some of these won't look good. You can look at companies like Hershey's. I love chocolate, man. Here's Hershey's. Cocoa prices are going up. Maybe that's the responsible. But we've been going up. We've been trending up. We have a nice strong bounce here, nice support level. And then if we were to buy, okay, if we were to buy, then some traders would consider putting a stop level below that price there. Okay. Now, Ranjit said, can you not run a scan for all the stocks? Yeah, rather than just do individual industries? You sure can. Absolutely. You can just do S&P 500 stocks if you want. You just go to S&P 500. That's go right here to public list. But what's the advantage of doing it this way? The advantage of doing it this way is targeting the individual sector, stocks in that sector that you want to see. Do you see that? That's the advantage of this, is there's going to be times when you want to target a sector that maybe has a stronger relative strength right now. And I'm not trying to push you to staples. I'm just saying this is the approach to using relative strength with sectors to identifying those stocks that are of interest to you. Now, some of them, what happened here? My scale's all messed up here on this. That's weird. Now we had the gap. Let me do that. Okay, here's Kellanova. This is the last one we'll look at that I'm going to call this a support level. Okay? Here's a support level. Now maybe you're going, look, I like the trend. Maybe you're thinking that. And we've got a support level near where we're at, but I want to wait for a bounce. Okay. You can always do a trade of like a buy stop order or something, for example, and say, I'm going to do a buy stop if the stock goes above, I don't know, 82.69 or something like, you can pick the level that you want, $82.50. I'm only going to get in there. That's where you do a buy stop and say, I'm going to get in if it goes up there. That's the possible way of doing that. BLR says, can you refine the scam by weeding out smaller cap stocks using something like capsize? BLR, yes, you can. But by doing S&P 500 stocks, I've already done that because S&P 500 stocks are large cap stocks. You can do what I showed you. However, you can add whatever other filters you want in that. So choose what you want. You could say, I only want to add stocks that are trading 5 million shares a day. You can do that, okay? Experiment, do with it. But once you save that scan, then it's this watch list that you can always refer back to. All right, everybody, I'm out of time. I want to thank you. Thanks, Barb, for helping me out in the chat. And thanks each of you for taking a little time out of your day here today. So Kevin will be back on Tuesday. I think James and I think myself are going to be on tomorrow morning for Trader Talks. And everybody, hope you have a great rest of the day. Make sure you subscribe to Trader Talks so you get future content that is of interest to you. Bye-bye, everybody.